CEPR.
Hi, I'm unmuted.
Perfect.
I'm just really here to watch Paul and take notes.
Perfect.
So I'll stay muted until I'm needed. I doubt he'll need me for anything though.
Okay.
Thank you, start.
Yes, I think we can start. The number of attendees is slowing down. The increase in the number of attendees is slowing down. So I'm Vincent Bignot. I'm from back of France, and it's especially a pleasure to chair the seminar about Paul Spelsing and Andrew Metrick. Andrew Metrick is actually in the room, but he is unmuted. But hello. And it's actually especially a pleasure because I mean it's a paper on banking crisis intervention, and it's an especially ambitious task, which is, I mean, especially needed. Which is, I mean, can we make a consensus on banking crisis and what type of banking intervention have been made or implemented by the public authority in order to cool down banking stress? And so the webinar is organized such that, I mean, Paul will have about 40 minutes presentation, and it will be followed by a 20-minute Q&A. And there is an additional slot time of 15 minutes for people willing to stay in the room and continue ask questions. I will moderate the question during this webinar. And so if it's a clarification question, I may interrupt Paul in order to ask him question. I mean, in that situation, I mean, if you want to ask a clarification question, please use the sharp clarification keyword at the beginning of your question, and then I interrupt Paul for those clarification, and then we will have a regular Q&A at the end. So thank you for attending, and Paul, actually the floor is yours. Thank you. Oh, I forgot to say that. I mean, you're a postdoc at Yale, and you're also a Bank of England associate. And so I forgot to present you, but everybody must Google you now.
Well, thank you so much, Vincent, and thank you so much to Rui and Nathan for organizing this, and for Mandy at Vox for organizing too. Let me share my screen, and let's kick right off. I hope you can see it all right. So this is a joint paper with Andrew Metrick, who is also here joining us. And it's, as Vincent has said, it's focusing on banking crisis resolutions and interventions in the very long run, if you will, for the last 750 years to be precise. And there is a large literature, of course, that has developed over the past years that is focused on banking crises chronologies. The most famous one that everybody will know is the Reinhard Rogoff banking crisis chronology in their famous book, going back to 1800, but various other studies have prominently come out. Schullerich and Taylor's, Leven Valencia's, of course, and most recently a QJE paper by Baron Werner-Sion. All of them are focused on identifying systemic banking crises episodes over the past decades at least, but multiple of them going back more than 100 years actually. And they have different identification methods to identify systemic events in the banking sector across advanced and emerging economies. You know, they apply different sorts of questions on top of these chronologies. Are crises becoming more frequent? Are they becoming more costly for the wider macroeconomy, for financial markets, etc.? But the general focus in these papers is systemic crisis events, largely from 1870, though of course Reinhard Rogoff go back further. Then there's a second strand of literature looking at banking crisis resolutions and interventions in particularly. And most notably, of course, Leven Valencia have an overview embedded in their chronology looking at the resolution measures. They focus on the late 70s onwards. And then there are various country-specific and country group-specific studies, often from IMF researchers, from World Bank researchers that have come out over the years that look at the precise tools authorities have used and whether they have been successful or not in resolving the bank stress episodes. Now, what we are trying to do here is to aggregate these two strands of literature into a comprehensive overview of banking crisis stress events and the resolution tools that have been applied over time, going back as far as possible as the sources and the literature allows us to do. And so we are merging all the banking crisis chronologies that exist in the literature with a new panel of what we call candidate crisis, where we identify hundreds of cases where authorities, either monetary authorities or fiscal authorities or private actors in the banking system, have intervened in the system and which are not yet identified or have not been identified as a systemic event in the existing literature. So we are detailing for the first time a very large historical sample of both systemic and what we call candidate crisis. You could also call them would-be systemic crisis, because these are bank stress episodes that did not turn into a systemic event. Perhaps because of the intervention measures, perhaps they would not have turned into a systemic event, even if authorities had not intervened. And we detailed the exact response across a large sample of individual tools that we will come to. But we also specify all instances where authorities have recognized that there is a stress event in the banking sector, but have consciously decided, after looking at the evidence, not to intervene. Right. So we also include a large panel of events where authorities have consciously replied in a hands-off manner. Then the next step that we are undertaking is to use long-run GDP data sets to pin down exactly the direct intervention costs that have been incurred in each of these events for all the events where the data allows us a precise calculation of the direct intervention costs. And we separate these costs across different categories: fiscal costs, liquidity costs, guarantee costs for these interventions. Now, it's important to say what we are not trying to do. We are not trying to reclassify any of the existing chronologies. We are not trying to argue with Reinhard and Rogoff or Leven Valencia about the precise timing of their chronologies and about the exact identification. We are not saying, oh, in 1873, we don't think it was a systemic crisis. That's not what we're trying to do. We accept the existing chronologies and work off that basis for the systemic crisis sample. What we are not doing at this stage either is judging the exact effectiveness of these individual intervention measures, though that is, of course, a key exercise that our new overview will enable researchers to do. But at this stage, we are not doing it ourselves. Then, as I've said, there are some overviews of direct intervention costs, but we would argue that our overview goes significantly beyond existing overviews and allows a long-run study of the evolution of these direct intervention costs and the precise sharing between the private sector and the public sector and between monetary versus fiscal authorities. These exercises will be possible. What we're also not trying to do, however, is to look at all the secondary costs, so the non-direct, the indirect crisis costs. We're not looking at that. If there is a wider output cost to a particular candidate crisis in the wider macroeconomy in terms of real GDP costs or in terms of financial sector assets that are fluctuating in the aftermath of a stress episode, we are focusing on the direct costs, not on any of the indirect costs that may also be significant. What we're also not trying to do is to document any interventions outside the banking and financial sector. So, for instance, within the bank stress episode in 2008, the US authorities obviously intervened in other sectors of the economy, i.e. GM. That's outside the scope of our exercise here, even though it is maybe falling into a banking crisis episode. So how are we classifying these interventions? We have 5 major intervention groups, and these are split into 21 individual intervention types. The major groups, as you can see, are lending, guarantees, capital injections, rules, and other tools. And we distinguish here between ad hoc liquidity assistance, for instance, so that is an assistance to an individual bank, and broad-based liquidity assistance, which is an intervention for the wider sector in this case. So we are distinguishing between different sizes and scopes of these interventions in the subcategories here. The other category here consists of a wide range of non-traditional tools or non more heterodox tools, which are also important in some episodes of financial history, and which will be illuminating to trace as well. And as I've said, so we're using a wide range of the latest GDP series here. So obviously, as every economic historian will know, the research has moved on a lot since the time of Angus Madison. There have been great new works on long-run GDP series. And we're using all these latest series to really calculate the direct intervention costs, as I've said. Now, to illustrate this a bit, our current sample consists of 995 crises, and these 995 crises are associated with 1,624 interventions. So as you can see, a single crisis episode can be associated with multiple individual interventions. I think that's intuitive, right? So obviously the '08 crisis in the US featured various individual tools and decisions to intervene in the financial sector. And so on average, every crisis is associated with 1.6 individual interventions over time. And so here you can see how our sample breaks down in terms of the canonical versus candidate crisis. So it's roughly half-half. It's 570 crises here are canonical crises, which have been at some point in the literature identified as a systemic crisis, and about 420 or so are crises which fall out of the scope of existing chronologies, where we say clearly there's an intervention. Authorities identified a significant stress episode at this point in time, and we can document that, but it's not been identified as a systemic crisis, but it's associated with particular interventions that we document. Now don't be confused with the numbers here. I'm only counting the unique crisis because obviously there's for the canonical sample, because there's a certain share of overlap between these chronologies. Okay. So what is our identification process here? It's relatively straightforward for the canonical crisis, because what we're doing here is we're looking at the existing chronologies, and we are looking at the exact sources that previous authors have used to identify systemic crisis, and we are drilling down into these sources that previous authors have used to identify the exact crisis response and the exact intervention tools during these canonical crises that have been used. Whether it's from the public sector, whether it's from the private sector, we use primary sources, secondary sources, everything that we can find that is associated with these systemic events. And since these are typically events that leave a bigger trace, that is relatively straightforward. Now, but then what we're doing for the candidate crisis is we are trying to undertake as comprehensively as possible an investigation of financial history literature, of economic history literature, to identify each individual case where an intervention did occur that is not yet associated with any systemic event. And there's a wide range of groups of literature that we use. So an obvious group of sources to start with is these bank level studies that people have published over the years. Famously, Raymond Rover's a book on the Medici Bank, but there are many other cases on Warburg, on Hope & Co., on investment banks in the 19th century, these kind of sources, and they often contain details on, Warburg giving an emergency loan to a competitor during a stress episode that has never been, really incorporated into any of these overviews. Another big group is institutional histories. So, the history of central banks around the world often contain very useful detail on emergency operations that are falling under the radar of a lot of the existing studies. So the new history of the Bank of England, for instance, contains great detail on some of the emergency operations into individual banks that are not necessarily blowing up into a systemic event. But then, especially pre-1945, there have been great studies in Italy on the financial history, in Italy on emergency operations in the early modern period. We had very volatile episodes in northern Italy, especially during the big sovereign default wave of the 16th and 17th centuries, for instance. And a very good amount of works have been published pre-1945 on the bank stress that the Spanish defaults, for instance, caused in northern Spain. And often these are Italian, Spanish, and German sources that have not been translated, but we use all of these to really construct our database here. We're also using some primary sources. The major calendar of state papers, for instance, we systematically search these sources for bank intervention, for bank default, for these kind of keywords to really identify any episode that might be relevant to include. But we apply minimum criteria. So if we don't set a certain threshold, you can imagine that we end up with just a bewildering amount of potential events that will not necessarily be of any use because we don't pre-select for relevance here. And so we apply minimum amounts of the balance sheet size or of the intervention size associated with an event to decide whether to include or not include that event. So I hope that is straightforward. And this second step really yields these 424 extra crisis episodes that I've talked about, where clearly we have a relevant intervention event, where we have a relevant underlying stress event in the banking sector, but it's not been identified as a canonical crisis so far.
Paul, just one clarification question. So if I'm correct, what you have isolated is a number of new crisis episodes and not crisis times year episode. You know, since a crisis can last, let's say, 2 years, what you have when you say there are X hundred more crises, you're saying it's crisis and not crisis and year. It's kind of an economist question. I'm sorry for that.
Right. So no, it's a good question. So if Reinhard Rogoff have identified 1873 as the crisis start year, so these canonical crises focus on the start years, but we say, okay, there was an intervention in 1872. We link that to the existing canonical crisis. So we're not saying, okay, just because it's a couple of months before the identified start date, we call it a new crisis. So if that is the case, if it's clearly associated with a previously identified crisis, we lump that together in the existing literature. We're not saying we're identifying a new crisis here.
Okay.
So it has to clearly fall outside of the scope of the existing chronologies for us to call it a candidate crisis.
Thank you.
Yeah. Okay, but good question. Okay, so if you're following that course of action that I just laid out, it turns out a lot of sizable events come up that are clearly of a big relevance for the fiscal, for the monetary authorities at the time. Just looking at the intervention size, for instance, I just referred to the big Spanish defaults, which triggered significant interventions in northern Italy, for instance. Here in Bologna, the authorities established a Monte Fund, you could call it an early SPV, to stabilize the banking sector with outlays of almost 9% of GDP, for instance, right? So similarly, in Venice, you had a massive recapitalization of the de facto central bank in 1739 after a massive spike in volatility, almost amounting to 30% of GDP. So these kind of events, I think everybody would agree that they have some relevance, some significance, but they often fall outside of the scope of existing overviews and existing investigations. And so this kind of approach allows us then to study the aggregate trends in much more detail, the evolution of responses over time. Most notably, what a lot of people might be interested is whether Badgett really turned the tide in terms of global intervention tools used, and if there was a sea change in the late 19th century after his famous book, for instance. So we can study these kind of aggregate trends over time. We can study the aggregate costs over time. And in another step, we or other people might be able to really come down precisely what is the best intervention tool, what has worked in the past, and really rank these responses in terms of effectiveness. So let me jump ahead a little bit here. And focus on this slide. So as I've said, we are including, I should probably show you this one first. So I said this is a database in Excel format that people can study and play around with. And the structure here in the first column, what we call the crisis code, is the 995 crises that I talked about, that partly are associated with the existing chronologies. So if Reinhard Rogoff, say, Germany 1873 is in their chronology, we have that in this column as GER 1873, right? But then the next column associates that crisis code with the individual intervention decisions of that crises, right? And as you can see, as I mentioned, an individual crisis can be associated with multiple decisions to intervene. Then we give details on the exact response. So whatever we can find in the literature, whatever we rely on to decide whether it's a relevant event or not, we give the details. We tell people what exactly happened and what the exact outlays were in terms of the total direct costs. In the next column, we have our intervention tool classification, the 21 categories I talked about. And then we give details if there was a private burden sharing, if authorities used an SPV, if they worked through the market, for instance. So if it's a market liquidity program, obviously, at times you don't target the banks directly. These kind of details are then included in the next two columns here. And then finally, we give an exact pin down of the literature, what we used, and the details here. So a couple of interesting results that we found. So what you can do with this approach, for instance, is to study in detail the evolution of private burden sharing in the crisis episodes. So in what share of crisis episodes was there a private burden sharing, or was there a hands-off approach, a conscious decision not to intervene by authorities? And this chart, for instance, shows you by historical episode what that trend looks like. It's very interesting. We think that the post-1980, the floating FX period here is remarkable for its low share of hands-off / private burden sharing episodes, for instance. So public authorities have become much more sensitive in the past 3 decades or so, 4 decades now, to intervene in cases where a bank stress event is identified. The share of private burden sharing or hands-off approaches used to be significantly higher during the gold standard era and during the interwar period, for instance. So these kind of analysis are possible. So a word on the cost calculations, which are important. So Leven, Valencia, for instance, have obviously provided fiscal cost, liquidity cost estimates in their famous paper for the mid-70s onwards for a lot of their stress episodes. Again, we are not trying to reinvent the wheel here. If previous authors have pinned down a precise fiscal cost measure or a liquidity cost measure, we use their figure and say so in the sources, right? So we're not trying to argue with Leven, Valencia about their cost calculations here, and we accept their approach. And the only thing we are doing in Leven, Valencia's case in liquidity instances, in terms of liquidity costs, they are measuring these costs in terms of the costs relative to the deposit volumes in the individual country. We are transferring that data to the current GDP denominator, right, to make it consistent. In cases where we don't have an existing calculation, this is an example what we're exactly doing. So this is Sweden 1907 from a paper that has just come out by Swedish researchers on the banking crisis in 1907 in Sweden. So these authors have studied in detail the Riksbank response in Sweden and provide the balance sheet data of the Riksbank during that critical period. And they are positing that the Riksbank supported the Swedish banking sector here by significant discount operations, and they provide the monthly Riksbank data here to make their point. And they're saying explicitly here, between August 1907 and May 1909, we had the Riksbank providing liquidity assistance to the Swedish banking sector. We rely on their data in this case to calculate, the area under the blue line between August 1907 and May 1909, that is above the pre-crisis level, okay, to come down on our liquidity cost estimate. So we are using both secondary and primary sources on the central bank level, on the treasury level, to exactly calculate these figures. But we always will follow existing literature if they have come down with a precise estimate and incorporate that in our database. So this is an example for Sweden. We just take the area under the blue line that is above the pre-crisis level here in that 1.5 years to arrive at our liquidity cost estimate. What is the distribution of all these interventions across our 21 categories? Here you can see that clearly the liquidity assistance measures were the most dominant over time by a meaningful margin, followed by capital injection measures and then resolution / organized liquidation measures. So we are showing the distribution here over time, all countries, all years. This is maybe a bit more intuitive by the 5 major categories here. How has that share changed and fluctuated since the year 1750? So we can see here again that the guarantee share has reached unprecedented proportions over the last 270 years or so in recent years. On the other hand, as I mentioned, the hands-off responses, the NOIs, have come down sharply compared to the gold standard era, for instance. This is by period. This is essentially showing the same thing, but by historical period. It also shows you the exact distribution of events by period here. Again, what is interesting is that we are returning to a early modern share of guarantee responses. Guarantees were very prominent in the pre-1700 era, and we've now reached a share once more that is much more comparable to these early periods rather than, say, the interwar period or the gold standard period. So these kind of analysis are undertaken. Then we distinguish between developed markets and emerging economies. Here it's interesting that advanced economies seem to rely more clearly on liquidity measures, on lending, than emerging markets. Emerging markets, on the other hand, have a slightly higher share of direct capital injections. Now you can speculate why that is the case, because of central bank credibility perhaps, because of the ability to raise foreign FX. These kind of issues may underlie that. That is a second step to analyze further. Then here we are distinguishing between the candidate crisis, so the would-be systemic crisis, and the canonical crisis that are already in the existing literature. Here it's interesting that there is a clear overweight in these would-be crisis on liquidity measures. So we have more than 30% of candidate crisis seeing a liquidity response, either ad hoc liquidity assistance or broad-based liquidity assistance. There's a meaningfully higher share than for the systemic crisis, and you could speculate that perhaps early stage liquidity provision therefore plays a part in averting a systemic crisis event. We are not coming down on a precise mechanism or a thesis at this point, but these kind of patterns are suggestive of long-run trends that might be associated with a particular crisis response. Here's an overview of the fiscal and liquidity cost data points that we have at the moment. So these are, it's not showing guarantee costs because these are a bit of a different animal, but they are showing over 400 cases where we were able so far to calculate the exact fiscal and liquidity costs. You can already see that the floating FX era, the post-Bretton Woods era, is remarkable for the uptick in fiscal and liquidity costs as a share of GDP. But we also had significant pre-1970 events, which for the first time we would argue we can now comprehensively compare and put into context here. This chart shows you, for one, the columns show you the exact number of events by broader category, and the blue line shows you the bank stress frequency in advanced economies since the year 1665. So this is not weighting the bank stress by GDP costs, right? It's simply showing you the country years that are showing some form of bank stress over time for a core advanced economy sample, for an 8-country advanced economy sample, covering 80% of advanced economy GDP over time. So here it's already suggested that our bank stress clusters are clearly associated with wider geopolitical / political stress events over time. We have a clear uptick in bank interventions during the War of the Spanish Succession, for instance, during the Napoleonic Wars, during the 1848 revolutions, maybe as you would expect. But it ties into a bit of into the Bordeaux Eichengreen is the crisis problem growing more severe thesis here, and we would argue, it allows you on a much more nuanced level to trace these kind of stress dynamics over time. And here again we see that the 08 crisis is certainly unprecedented in terms of the share of advanced economy GDP that is affected at the same time, while the Bretton Woods period is remarkable even in the very long run for its very low crisis frequency. Now, what we can also do is distinguish clearly who is in charge here in the crisis resolution. Is it the fiscal authorities? Is it the monetary authorities over time? And what share of GDP is used for banking crisis interventions in the average year? So what this is doing is it's arithmetically weighting all the countries in our sample, basically multiplying the crisis frequency with the cost outlays, right? So the way to read this is that during the floating era, on average, 0.5% of GDP in any given country is used for bank sector interventions. Yeah, this is not GDP weighing it on the global level, but on the country level, on average, 0.5% of GDP is used for bank interventions every year since 1970. And you can see, interestingly here, that the fiscal authorities nowadays are the dominant source of these funds since the 1970s, whereas in the gold standard era and even during the interwar period, the Great Depression years, there was a much larger share of monetary authority interventions here in terms of the total cost outlays. So once more, you could say the fiscal authorities are in the driving seat in the resolution of banking crises.
Paul?
Yeah.
Oh, takeaways, perfect. I was about to say that you have 3 minutes left.
I guess I'm running out of time, yeah. So what are the takeaways? We provide a new and very nuanced overview of banking sector stress and intervention patterns over multiple centuries using the one of the most comprehensive aggregations of literature, of data, primary and secondary sources to arrive at these aggregate trends and stress measures over time. We were able to see that interventions per se and stress events in the banking sector triggering authorities' response existed long before budget and long before modern central banks across all sorts of types, fiscal, liquidity, guarantee types. But that there is a dynamic picture here. For instance, the rise of guarantee measures is very interesting and might point towards, very relevant structural features of the past years. And it might indicate, a more successful or a less successful trend in banking crisis resolutions. That's an open question. But clearly, for instance, what we were able to show is that there's a historical trend towards capital injections and guarantees at the expense of rules measures over time, for instance. Then I made the point that crises, bank stress, are secularly increasing in frequency over a multi-century period. They are also becoming more costly for authorities, with a clear break in 1945. So remember the chart I showed you that on average now 0.5% of GDP is expended on banking sector interventions every year in the average country. And fiscal authorities are back in play in the crisis resolution in many ways. Maybe that's counterintuitive when you think about the major interventions by the ECB, by the Fed in recent years. But for instance, during the 1990s, the Asian countries relied much more heavily on fiscal authorities, and that's showing up. And what is also, we would argue, a very relevant finding here is that the share of hands-off / private burden sharing responses is clearly secularly decreasing, and it has reached unprecedentedly low proportions. So monetary and fiscal authorities have become highly, highly sensitive to episodes of bank stress in the long run context here. That's really a unique feature of the 1980s, post-1980s period here. So this database allows a lot of future interesting exercises, we would argue. It can serve as a playbook, obviously, on how to avoid the graduation of these candidate crises into systemic events. You can study in detail for the first time over the very long run whether there's a pattern in the early crisis intervention that is causative here, is causal to the avoidance of a systemic event. But you can also link these aggregate trends to macroeconomic series and measures, obviously. As I said, we are not studying the output losses, the wider financial sector costs, but it enables you to do that in the future. For instance, gold standard resolution versus floating error resolution, these kind of exercises are possible in a comprehensive way. And just to finish, one example here, the blue line is showing you the risk premium, private versus public long-term rates, and the red line is showing advanced economy GDP bank stress. So it's the same country sample, period averages here. And this is suggestive of the fact that perhaps the rising incidence of private sector stress events and costs associated with these events may be underlying the divergence between private capital returns and public capital returns that a lot of people have looked at. So this is one of the macroeconomic applications of our data that I just mentioned, but it's just an example at this point. So I close here to have time for questions. Thank you so much for the.
Thank you, Paul. So there are already a number of questions, but Chris Meissner, I mean, if you want to answer directly, to ask your question directly, I mean, I'm not really sure if Roy or Nathan can help me, but the question is long enough and conceptual enough so that I prefer Chris to ask it directly.
Okay. Thanks, Paul. That was really awesome. Impressive amount of work here. So I have a lot of questions, but in the Q&A room, I asked, do you venture a guess as to the relative cost of a preemptive strike versus a kind of intervention that comes after a more, I think you called them canonical crisis? And my second question may or may not make sense, but I mean, in what sense are these costs? Sometimes they're transfers, sometimes they're costs. What's the difference? So thanks again. That's great. Great work.
Oh, thank you, Chris, for the great question. I'll start with the second one. So very good point. We are calculating gross outlays here, not the net costs. So of course, some of the liquidity outlays that initially the central bank provides is paid back over time. But in that sense, we follow Leven, Valencia, and others who have, for their base case, have operated with gross costs here. Now we are for the guarantee costs. As I said, it's a different animal. And we are distinguishing in this case more clearly between what are the actual outlays for the guarantee programs versus just the total amount guaranteed. But for the fiscal and liquidity costs, which are the two big ones over the long run, we are focusing on the gross costs only. And the first question was on total costs for the candidate versus canonical crisis. So I can show you a chart right now distinguishing clearly, but it would be an easy exercise to do because we can distinguish in the database clearly between the canonical and candidate crisis. I would venture that, as I said, there's a higher share of liquidity responses in the candidate crisis. I would speculate that the initial costs are actually higher in the candidate crisis than compared to the canonical crisis, because the liquidity costs are generally higher than the fiscal costs in our overall sample. In the future, I hope to give you a precise, exact GDP figure for that. But it's really something that the database enables you to do in an easy way.
Thank you, Paul. So one question from Maëlys Alvaro who ask you, I mean, when coding for who is intervening, especially the Bretton Woods era, when the monetary authority are not independent from the fiscal authority, and then can receive, let's say, order to intervene. I mean, how do you take into account the fact that they are not autonomous, and so in a way, I mean, the frontier between monetary and fiscal intervention are blurred a lot.
So that's a good point as well. We take into account if basically the central bank is then recapitalized by the fiscal authority after an intervention event because it has run out of funds, and that captures the link between fiscal and monetary authorities, for instance. So we have these cases where you have massive outlays, and then the central bank says, look, since we are intertwined, can you give me fresh funds from new debt issuance? So we would code that as both a fiscal and a liquidity gross cost, and capture both. We capture the fact that both sectors are involved in the resolution.
And so related, I mean, two related questions from me. I mean, in terms of you're labeling liquidity as a cost. I mean, from a central banker point of view, I mean, it's a bit bizarre since, I mean, most of the money that is lent, especially, is reimbursed, and asset purchase are usually, in crisis time, are usually very profitable. So I understand that from the point of view of the media, I mean, it's kind of okay to say it's a liquidity cost, but in fact, I mean, it's much more something like, I wouldn't say it's even a cost. I mean, something that you put on the table is reimbursed later in time. Andrew.
Yeah, so look, we need a better word than cost.
Yes.
So you're absolutely right, and Paul and I have gone back and forth on this. I mean, and there's a variety of good objections here. One is what you just said. The other is we've got liquidity cost, guarantee cost, capital injection. They're obviously all different from each other, right? So a guarantee saying like we're going to guarantee €1 billion is very different than actually handing a bank €1 billion. So cost has always been a troubling word. It's what the literature uses, but it's not really great in our context. So we may just need to relabel it intervention size or something like that, just so that it's less confusing. But your objection is correct.
Yes.
It's not really a cost the way we would think. It's not even a gross cost. It's an outlay.
Yes.
Or it's a number.
Yeah. So one question, I mean, that pop up is whether the data are kind of censored. So let's say the crisis, the way you're censoring the crisis is there is a public outcry, and so some historian at some point realize that someone, I mean, complained against a crisis, and because of that, then I mean, you're able to see the crisis. But I mean, first, I mean, banking, I mean, as a kind of, there is an history of banking, of development of banking. And so, for example, I mean, in a number of language, I mean, banks is not even used as a word for financial intermediation, let's say before mid-19th century or mid-18th century. So somewhere it may depend on the place. But there is also this idea that, I mean, it's okay, but I mean, since you're searching for public intervention, so there is a public outcry, so there is a public intervention, it's kind of okay. But then, I mean, the census of financial crisis or banking crisis is kind of, I mean, must be by construction and must miss a lot of crisis. And there is another dimension of that, and it's related to the fact that the threshold you're using to qualify a crisis as a crisis is actually not country dependent. So that, I mean, when it's 5 million of pounds, for example, I mean, the richer you are, the more crisis you will get as a country. And it's also the case that, I mean, the 5 million pound, I mean, threshold, I mean, is easier to catch or to get above, I mean, say early 19th century than, let's say, 15th century by construction of the fact that there is economic development. And so how do you think about that? And do you think about adding this kind of methodological discussion on that?
No, these are great points. I mean, you could think of using a percentage of GDP threshold instead of an absolute figure here. The threshold de facto it applies to advanced economies, say in the 17th, 18th, 19th century, which are relatively comparable in terms of the per capita income, at least in contrast to, say, the gap between the US and Chinese per capita income nowadays, you know. But it's a good point. We should probably control for size to GDP, because we can implement such a threshold. We have the underlying data. Your first point, of course, I mean, selection bias is an issue. The thing we would say at this point is we try to be as comprehensive as possible, really going through everything we can find, like a big Hoover and hoovering up primary sources, secondary sources, everything we can find. The good thing is that, look, each time the authorities actually face the decision, should we intervene or should we not intervene, that is already a high bar for it to leave traces somewhere, right? If there's a Bank of England board coming together and deliberating on rescuing a certain merchant bank or not, these kind of decisions leave traces. Whereas you're correct for the NOI instances, where we are simply saying there's some sort of stress event and we don't know what else happened. That is a much higher bar to really claim that we are comprehensive here. On the point, obviously, you're totally right that the banking sector was not called necessarily the banking sector in 17th century Holland or so. We are discussing that in the paper, but the equivalent is the merchant banking community. And you have all these cases where the Fuggers, for instance, they are active in both corporate ventures and in financing at the same time. So it's a bit like a wholesale funding business nowadays, or in Japan, these big Mitsubishi, for instance, that are active both in industry and in finance, and these types of banks come up in the early modern era. But we say, look, any business of this sort that is engaged in a meaningful financing business next to industrial ventures is a de facto bank in our classification. And I would say that's a fair characterization, although you're right that the lines are definitely more blurry in the early modern period.
So actually it was not only my question, but one by Stefan Gerlach and the other by David Chambers. So let's spread them. So one question, I mean, that is related to Charles Calombere's point that, I mean, which type of intervention in your data set can you argue to be more or less in favor of public interest? And so, for example, I mean, the Orkun Saka, who is asking the question, say, can the recently increasing likelihood of equity injections, so the use of taxpayer money after crisis, be a result of the increasing political or regulatory capture by banking modern times? So kind of endogeneity, say, of public intervention to the fact that banking by construction is a lot about politics.
That's an interesting question. I mean, I might defer to Andrew if he has any particular thoughts on that. But I mean, certainly I would say that on the aggregate level, it is very interesting that the share of private burden sharing per se / hands-off approaches is definitely declining. Now, I wouldn't say that is prima facie evidence that you know, this is a capturing of private interests of the state. Because the state has obviously a big interest to keep volatility low and to prevent spillovers to the labor market and these kind of sectors. But it is, you can definitely say that we are suggesting that the authorities have become much more sensitive to any kind of volatility in the financial sector. I wouldn't go further than that based on our data. I wouldn't speculate on whether it's some sort of capturing going on or if there's a particular I mean, we do find that the AHCI category, so the capital injections, is on the rise. But can you say that this is representative of some sort of, equity shareholder capturing of these kind of events? I would be careful to go as far. But if Andrew has any thoughts, he should jump in, I guess.
Yeah, no, Paul, your answer was excellent. And I would say just that in general, Vincent, our ability to make these broad historical statements, which we'd like to make, is mostly limited right now to the extent of your previous summary of people's questions, which is, what is the sample selection process that we have? Clearly, any sample selection process that relies on some kind of threshold signal that might vary cross-sectionally and sometimes makes it hard for us to draw the kinds of conclusions along those lines. And so it's absolutely the case. There will be a methodological discussion right now in the paper. It's really more just the facts, but we're adding a methodological discussion about the sample selection. And then that's our main challenge for making the broader historical sweeping statements.
I think you're muted, Vincent.
Vincent, you're muted.
Sorry. So the last public question before turning to the off session of Q&A is Chris Meissner's suggestion to also mention Bordeaux, Icon Green, and a co-author data set of 2001. So actually, let's say it seems that your paper is in the wave of moving banking history from qualitative history of financial crisis towards something that is much more quantitative. And so I will add to Chris that, the first one I read is, of course, of this kind of database is actually Kindleberger, Mania, Panic, and Crashes, which, of course, is a database, even if it's not in an Excel file. So thank you for this first part, and if there are, I would be happy to stay since I have a lot of questions. But if others want to stay for 15 more minutes, that would be very cool. So,
oh, thank you so much, and we are definitely indebted to Bordeaux and Eichengreen as well. We mentioned them in the paper, and also others like Roma and their chronologies. Yes. But there is a good share of overlap, and we take that into account absolutely in the construction here. But thank you so much, everybody, for the great questions and the feedback. It's been a pleasure.
So there's one question. If I'm continuing, so there is one question that say, there seems to be an increase of the capital injection post Napoleonic War or French Wars, say 1815, and post World War II. And do you have an idea, an intuition of why this occur?
I would venture that equity as a share of GDP is just accelerating significantly post 1815 or so, with another sharp spike after 1970 or so. If you look at Schuleric and Taylor and their breakdown, whereas the paid-in capital to GDP in the banking sector rises much more slowly, and this might be one reason, or that the equity volumes are rising faster than the liquid assets on the balance sheets, which were already significant in the pre-Napoleonic era. So it's especially the stock market that has above average growth from the 1970s as a share of GDP in advanced economies, at least, and that might be the reason that they increasingly need to take into account direct equity injections. That's a speculation. I'm sure you can use Schuleric and Taylor series, for instance, to trace it, and compare it in detail.
Okay, so a question by Alvaro Silva who asks, do you think that this rise of guarantees plus capital versus rules may reflect a more widespread idea that banking crises have so much of idiosyncratic that rules are always in a retard to the next crisis. So say maybe, I mean, it's kind of whether rules were the case before, and it was much more easy, let's say, to access the central bank, let's say pre-World War I, than post-World War II, where everything was restricted to the banking sector. And so in a way, I mean, requires something like less commitment, and always the central bank, I mean, going after the next banking issue.
I mean, the most convenient tool in the fixed exchange rate era was suspensions and debt moratoria, and these tools don't require initial outlays, right? It's very convenient. It protects your central bank reserves in a very convenient way, and it puts the entire system to a pause, right? And lets people reconvene. And so it makes intuitive sense for policymakers to focus on these measures. At the same time, I showed in the paper both the direct outlays, the cash outlays in gross terms, and the guarantees are on the rise. Yeah. So it's an interplay between more and more cash outlays in gross terms, and a much higher use of guarantees. And so that comes at the expense very clearly of these rules and non-cash responses in general. And the floating era makes that much more convenient. You don't have to worry about gold buffers anymore, and that's I mean, intuitive, I would say as well. But it's a combination of more and more cash outlays and more guarantees.
Okay, so Rui wants to ask a question. Rui, can you turn?
Slash a comment. So the question is about the evidence you showed about the breakdown of monetary and fiscal interventions, right? So there was a period which you flagged as the classical gold standard, where there was a much larger share of monetary interventions, which goes against intuition, right? So if monetary rules were firm, that should not be expected. So are these actually interventions in peripheral economies, the ones that were not on the standard? Because otherwise I can't really understand what was going on. The comment is on what you were debating earlier on, what Andrew referred to as a sample selection issue. And I wonder if it's really a sample selection or just a problem of mismeasurement, right? Because if you can reduce this to a problem of mismeasurement or misclassification of a categorical variable, I guess it will be much easier for you to deal. So, you have panel data, there's a possibility to actually estimate the misclassification probabilities, right? Both the false positives and the false negatives. And so you wouldn't need to, introduce so much structure trying to estimate what was the likelihood of a crisis getting into the data, because this is just a question of observation. There is no endogeneity involved in this. Thanks.
No, it's a great point. I mean, it certainly occurred to me as well that we have this suggestion that the monetary authorities are in charge. At the moment, this sample also includes lending by the private actors during the gold standard era. So I lump them together here. I lump all the AHLA and BBLA together as the monetary authority response. And maybe if you subtract the private lending, remember this is still a meaningful share of the total interventions during the gold standard, then it might be more intuitive. On the other hand, look, the Bank of England is suspending Peel's law during these bank stress episodes, and many other countries do the same. If they see stress, they're saying, look, the conductor of the orchestra in London is doing it. We are doing it as well. We are suspending the rules, and we pump liquidity into the system for a limited amount of time, and we will return to the rules after the stress period is over. You see that it occurred to me that you actually see it in a lot of countries outside of Britain. And so that might be actually one of the reasons that we're seeing that, which might be underappreciated so far, that this type of dynamic is more widespread than we thought.
Yes, David Mitch has a question, and since it's about financialization, I mean, if you want to turn on your mic, or if, let's say, Rui or Nathan, you can turn on Dave Mitch mic. It's
okay. Can you hear me?
Cool. Yes.
Yeah. So this is a simple-minded question.
No longer.
Is it okay?
Yes.
Yeah. But I've seen this work by some economic sociologists arguing that there's been this, what they call financialization, a market rise in the sort of size of the financial sector relative to the rest of the economy in recent decades. And this was a major factor behind the 2008 financial crisis. So I was just wondering, and looking at the magnitude of these interventions I mean, this is really very impressive work, like the others are saying, but I was wondering if that should be taken into account in interpreting what you show in the last few decades about the sort of size of the interventions relative to GDP.
No, totally. That's a great point. And as I mentioned, Schuller, Rick, and Taylor, obviously, and others have documented that we have this massive increase in total financial assets to GDP, especially from the 70s onwards. And of course, you would expect, as the financial sector per se grows, then your average intervention size as a share of GDP should grow roughly in proportion, right? If the frequency doesn't change. We are working on a precise series to as a share of financial assets. I mean, these series are increasingly available for the core and non-core countries, so it would be interesting to see. But at the same time, I mean, it is Leven, Valencia, and many others still prefer to measure it as a cost of GDP for good reasons. I would say, because it is an eventual treasury and real economy outlay that the fiscal authorities and that the monetary authorities undertake in the first instance, right? The fiscal authority, especially when you think about emerging markets, it cannot readily always tap into the aggregate financial sector assets in the initial rescue phase. And so it has to take the tax base, which is much more linked to real GDP rather than to total financial assets. And so I would say that there are good reasons to, in the first instance, to focus on the GDP costs. But totally, there is another parallel trend in significantly rising total financial assets, which we wouldn't downplay that trend,
So, if the last two bits, what's next? What are you planning to do? Extending to? I look at France. There are a number of banking crises that are obviously not there, which is okay because you acknowledge that. I mean, it's a very complicated task, which of course, I mean, is going back to the kind of sample selection issue, because I mean, if let's say central banking in France is different from the Bank of England type of central banking, then you don't get the same type of banking crisis after that. But at the same time, I mean, I understand that there's a lot of cost associated with collecting the database, and the database is already very rich. And so in terms of data collection, I mean, what do you need? Do you need?
You might be looking at the December version, which is
yes.
online. Especially our French sample has grown meaningfully.
Perfect.
But always feel free to send over suggestions for stress events, I guess. No, it has grown by another 40 pages or so since just in terms of the event studies since December. And no, I mean, an obvious extension is now to look at the question what worked and what didn't work historically, and you know, are the wider macroeconomic costs associated with some sort of intervention pattern in the past that seems to have worked better than others, and especially the graduation question that I mentioned. Is there, I mean, I showed that these would-be crises are definitely more associated with liquidity interventions. I mean, can we really posit that there is a pattern of early-stage liquidity provision that successfully avoids these kind of graduations? We don't have conclusive evidence, but that would be an obvious thing to look at. What underlies these graduation patterns, and what prevents would-be crisis from turning into systemic events? I think we can definitely say something about that with the current sample. So that would be my guess to incorporate that.
Thank you, Andrew. Do you want to add something before we close the session?
I'm trying to talk Paul into extending, you know, from what are now financial sector innovations to a much broader category, you know, of monetary policy, fiscal policy that follows crises. But you know, he's the one with the historian skills. So I got to get him excited. I got to get him suitably excited about it. I'd like to do that.
But I can understand his reluctance to move completely.
No, I'm not reluctant. It's a very obvious question, because we are only capturing a small share in some instances of the total outlays. Obviously, if people say we don't rescue the banks, but we would want to protect the labor market or the wider economy from this bank fallout, but we don't want to reward, in terms of moral hazard, we don't want to reward the banks. And so at the moment, we're not capturing the fact that authorities might choose to intervene in the non-banking sector in a stress event. So I think it's actually a great proposition to expand it.
Okay. So thank you very much. And
well, thank you so much, Vincent, and everybody with questions, and the organizers in Geneva. So thank you so much for that.
The next seminar, is next week, and it's at the French Assigna. And I encourage everybody to attend. Thank you very much.
Thanks, Andrew.
Thank you, Vincent.
Bye-bye.
Thank you, Paul. Bye-bye.
Thank you, Nathan.